Got it. Okay. Mic's on. So let's talk about why you would do seller finance in this market. I was kind of saying, being in the market as long as I have, I've seen different markets. I love the change in the market right now. Whenever there's a new market, a lot of agents get scared about it and panic about it, and I get excited. So like, great, there's new market, new opportunities, and those of us who are passionate and go out to do it are going to really can succeed in any market. So for your clients and financing.
Get buyers in the home that can't qualify traditionally right now, open up options and doors for them. And same on the listing side, if you're not having much movement, allowing your seller to do seller finance option might get more activity on that side as well.
So there's potentially advantages for both buyers and sellers, and also for agents. So you guys can make some more money. Doing more deals and making more money, is that still important to agents? Okay. What other advantages other than a buyer maybe they can't get into financing?
Seller can make a lot more money than what their current mortgage or their current monthly payment is. They
Yeah.
can make it into an asset or cash flowing in a sense asset.
So we're going to talk about three pieces to this today, and I want this to be conversational. We're going to talk about trying to help your buyers get into homes that maybe don't have the down payment, can't qualify, for some reason they're not ready to get that mortgage yet. We're going to talk about helping sellers, but I think also a big one is for investment. So you're right, if someone bought a home at any time in the last 5 years or has financed it, they probably have an interest rate between 2.5% and 3.5%, which is terrific. And now if market is 6%, there could be an opportunity that they could sell it, seller financing, and get money as a mortgage lender, get that sort of that spread without having to be a landlord and take care of plumbing and some of those issues. Why else would we do seller financing? What other scenarios do you see that could work for seller financing?
People that don't have good credit, but good income or sitting all the cash, I guess.
Yeah, if they don't have good credit, another thing is sometimes if they don't have time on the job, like, has anyone ever been in real estate and tried to get a loan in your first 2 years? A lot of times if you're in sales or if you have a newer job, it requires that you're on the job for a certain amount of time. So you could have good credit, you could be making good income, but not at that spot where you can get the financing. So I think that's a good option too. So who here, has anyone tried to do seller financing deal? Okay, tell us about the deal you did.
I remember it was probably last year I did it, and every time I did it, she helped me a lot with them. But I remember like the terms are all different, kind of when you're gonna like either refinance it or buy out the property. Pretty much, you kind of have like a set term of how long you're gonna do the seller financing for.
Yep.
And then you usually have like a down payment up front. I know there's a lot of ways you can structure them. They're all very different.
I think and you did one. What was the scenario that you did?
Mine was for one of my friends who couldn't qualify, but he had a lot of money in that situation.
Yeah.
Seller do seller finance, so he buy a house.
Typically on a good market, the seller is going to require quite a bit of cash down. And so if you have somebody that has cash, but for whatever reason doesn't have the credit, it's a good option. Another scenario that I've used it for that I think is a good trick for you to think about on this, and we'll dig into it a little bit more, is if you as an agent or a client of yours wants to do fix and flips. Typically on a fix and flip or some sort of investment, if you're just adding to your portfolio, you want to go out and get a loan. And there was Ashley Jensen has a listing real close to the office. I'll pull that up, but it's a complete fixer-upper. It's about $400,000, and it looks like it's been on the market for a little while. So in something like that, it could be that you've got a landlord or a seller that doesn't have the $40,000 or $50,000 to put into fixing it up and is looking for someone to come in and do that. So seller financing might be a good option where we could get that under contract on seller financing, do the improvements, and then once it's improved, either get it appraised at that point and keep it and get financed, or just sell it. But that would also save you the money of having to get a new loan. Does that make sense? Okay. Hi, welcome. How are you? Great. Okay. So you started on the the scenario of the different terms. So I think the biggest challenge in this market where seller financing isn't very common is having the conversation with a listing agent or a seller about how we're going to do that. When the market was slower, you could see that agents would list. It was actually an option on the MLS that seller financing is available. And I would be willing to bet, oh, I have to change the whole presentation if the broker's here. I'd be willing to bet right now there's very few homes on the MLS that are listed as seller financing. So it is probably a little bit more work on you guys if you're representing a buyer and talking to them about that, to go out. You have to call the agents, ask them if they do it. Most agents are probably not even going to be that familiar with it, so that you can't just take a no for an answer. You have to present your client's case somewhat to do that. So the sort of the basics on this, we talked about the buyers and sellers and the agents, but on most seller finance, if you're just going straight seller finance, we're also going to talk about lease option. Have you guys seen the seller finance addendum on the MLS? Okay, and that's, I've got a contract pulled up. On the seller finance addendum, you put out how much you're going to put as down, what the interest rate, and you made a great point, it's usually the term of it. So when we used to do these more often, we would try to make it a shorter term, like either 12 months or 36 months that the note would be paid off. And that would be to entice the seller to say, hey, you don't have to wait around too long. We can get you paid out if they have some equity on it. In the case where it's a landlord that's maybe tired of taking care of a property, they may want a longer term, because if they can get a 6% interest as opposed to putting the cash in the bank, they may want to have a prepayment penalty and say, let's stretch this out like 5 years. Does that make sense? Okay. So what, yes, Dean.
When you set up like prepayment penalty or something like that, that's something tied to the draft.
Yeah. Yeah, that's a great question. So on the, let's kind of back up here. We're talking about, we'll walk through a deal with all the paperwork also. What other, you look like you've got, is that just your regular, I'm curious face, or do you have like a question? Are you,
No,
do you have any specific questions about seller? Okay. Okay. So let's just go backwards. I appreciate you saying that. Let's go backwards to say on a seller financing deal, it is really similar. If you're the buyer and let's say there's a house for 400,000, you could make an offer for them as the agent. Let's just say you're making an offer for 400,000. What would be if you were doing a typical loan? It'd probably be about 10% down, or FHA might be 5% down. But if you're, let's say your buyer can come up with even $20,000. And the nice thing is where they're not qualifying for a loan, if it was FHA, they may have to show how they got that $20,000 they're seasoned. I think another nice thing with seller financing is you could probably get that money from a friend or a family. You could probably even pull it out of go get some loan against some other asset that you have. So another advantage is that you don't really have to show where that money came from. So let's say you made an offer for $20,000 and it's 400,000. In the offer on the real estate purchase contract, this one, we use the example of, I think it was, and this is a listing that Ashley Jensen has. It's literally 6 blocks from the office. I think it was listed at 375. So on this one, we'll just walk through this. You make the offer for 350, earnest money deposit of $3,000. And again, this is just random. I'm trying to walk you through a scenario. And then you show in there that you're asking the seller to finance $300,000. And the balance of the purchase price is 47,000, which is a total of 350. So it's really the same as if you're writing a regular offer. The only difference is instead of going out and getting an FHA or conventional financing, you're checking their seller financing. Does that make sense? So to answer your question, it's if you just think about the seller, if I own a house, I'm going to act instead of having First Colony Mortgage or somebody get the mortgage, I'm going to, as a seller, I will finance that. Everything else, yeah, go ahead.
So obviously, not everyone's gonna be up for seller financing. I mean, you're basically gonna be looking for people that, maybe selling their home and not buying another one. They still want to have some type of income stream coming in. What's the conversation that you have with seller financing?
That's a great point. I think part of understanding this stuff and getting familiar with it, because it is so unfamiliar right now in the market, it's the sellers, but it's also the other agents. And I think some of the scenarios you talked about of them not wanting to buy a home. Here's a scenario that I think is going to be pretty prevalent in the next year or two. How many of you guys have buyers that were in a bidding war and paid like $450,000 or $500,000 for a townhome in Utah County? So it's pretty common, right? So is it possible that any of those guys may have overpaid just a little bit for that townhome? And let's say there's 10 of those people that you've sold homes to. Is it possible that out of those 10, somebody might get a job transfer, lose their job, get divorced, get married, have some reason to move that they didn't plan 6 months ago when they overpaid in that bidding war to get the property? So when the market shifts, I think that's one of the opportunities you'll see where seller financing makes sense. And I was listening to the PC program calling some for sale by owners. And one of those was the exact conversation. Hey, I just bought this thing about 6 months ago. With my closing costs and everything I'm put in, I can't afford to pay an agent to get out of the house. So in an appreciating market that we've been in, everybody had equity so they could sell it and most likely make a profit in the last few years. I think in the next 12 to 18 months, we have a decent chance, even if the market continues to appreciate at 4%, there's going to be people that rolled closing costs or put some improvements who are what we call upside down. So even if they do sell it, they may have to write a check to an agent to get out of it, or they don't have any equity to go buy another house. So in that case, your buyer could come in and be valuable to them because they could cover that mortgage. And even though if those guys are selling, they may not have a down payment to go buy another house, but at least they're out from under the debt if they're getting transferred. Does that make sense? And
Well, if they're, a lot of them are reluctant because their name is still on that loan.
yeah,
But also you're in a situation where if it's listed, you know, you've got to come up with at least 10% down to cover closing costs and commissions and
yeah.
everything else. That they use. So,
Yeah, and it's sort of a unique scenario. It's certainly not going to work for everybody. And I think if you have a buyer that has cash, there's a better chance of it happening. And I think the market has to get a lot worse than it is today before sellers are willing to do this for $2,000 or $3,000 down. So really, again, it's if your guys have some cash or if the seller doesn't have equity. And the other scenario that we said is that if the seller like Becca or somebody that's been buying rentals is like, I'm sick of managing this rental. I've got a 3% interest rate and 100,000 equity. If someone gives me 50,000 and pays me 7% interest for the next 5 years, I'm getting the same cash flow essentially as owning the property. I'm just potentially giving up on some of the equity raise. What was your question?
So does it get to the point that you're willing to do it?
Yeah, it has. And that's where I had, I acquired a decent amount of my portfolio I acquired by doing lease options and seller financing. And it was, my favorite were some of the discount brokerages when it was before Homey, but they would have discount brokerages and it would say right on there, call the seller directly, which that's their own fault, right? So I'd call the seller. I had one property in Cottonwood Heights that I acquired, I think for $2,500 down on seller finance, but it was exactly that. It was a flat to declining market. She had got married, moved out of the house and couldn't sell it or rent it. And I called her on a Saturday because it was a discount listing on the MLS and she was in tears. She's like, oh my God, I'm behind 2 months of payments. I can't make another payment. My agent never calls me back. I've had no activity on this thing. I need help. That's well, I can help. And so I went, and the deal I put together with her was I wrote her a check that day for $2,500 so she could make up the 2 months she was behind. We did a seller finance deal. I think I put another 3,000 down. We closed, and that's the other thing is you can close pretty quickly. Like she was really feeling the pain. And what I think we said, we'll close it in 10 days. I'll do a home inspection and close it. And so yes, she was still on it, but I just went and rented out the house and made the payment. So we haven't been in that market for a while. So can it get that bad? Probably. It's been a while since we've been in that situation.
Seller financing versus lease option, that sounds more like a lease option. Seller financing, they give up title. Lease option.
Yeah, and I've done both. The lease option is a great way to do it, and I can walk us through one of those too.
But my question really is where's the line for percentage wise, put down? They say that this is a seller finance. I tell people, they need to put at least 10%, 50% scheme before we consider seller financing. But it's just
That's up to the seller. I agree with you that it's really hard to convince somebody to do seller finance without at least 10% down. Because why would you? To me, if I'm the seller, there's no way I would do that. I want to see that it's going to be enough money that you're not going to walk away from it. The scenario I just showed you, it was a flat market. This lady was desperate, and $2,500 to her was a lot of money. Like she was behind that much. They're making payments on another mortgage, and she wasn't built to be a landlord and was trying to do all the fixer upper, and it drained her. But I think that if you're dealing with buyers that have less down, it probably is a lease option where you could get away with maybe 2 months rent as a deposit or an option money and go from there. And you also bring up a great point, and I think you were knocking on the door. If there's not enough money to pay the agents in it, it's pretty hard to get the other agent excited about going to do the deal. I mean, you could potentially carry yours as a note, but we like getting paid for what we're doing. So there should be, I would say, and again, how much time do you want to spend with a buyer that doesn't have at least 5 or 10% down? Yes.
I wonder if we can maybe touch on this, because I don't want to go down a rabbit hole, but you talk about why someone might want to do lease option versus seller financing, or which scenario might be better for certain instances. I understand with seller financing, title does transfer, with the lease option it doesn't. But can you kind of talk about maybe why it want to be better for certain scenarios?
Yeah, let's think about that from each side of it. So usually on a seller finance, you agree to the price, and I'm saying I'm going to buy this house for, in this case, $350,000, and we're going to close in 10 days. So once you do that, you're taking on the risk, you own it. So if the market goes up or down, you either share in the upside or share in the downside. That's one thing to look at. I think one of the initial reasons why we used to do lease options as a way to get into it was people that had credit problems. And some credit problems are bad enough, like if you have a judgment or you're trying to get through some medical costs or something that could attach to the property. As a seller, I wouldn't want to take on that stuff if that was your problem. And as a buyer, you may know that you have that and say, I'm on a plan to get through this, but I'll need 12 to 48 months or whatever to clean that stuff up. So in that case, a lease option might make more sense. There was a book that I read years ago about using the lease option as a strategy as a seller. So I would go theoretically buy stuff, and then instead of being property management, I would say to you, say, hey, young guy, you're making some cash, you don't have very good credit yet. Why don't you give me a $5,000 option? And if you close within 2 years, I'll do it at this price, or we'll appraise it at that, and I'll give you like 10% of your rent as a credit towards it. So as a landlord, like let's say I bought the property for 300, I sold it to you for 350. So I built in a margin. I'm getting the monthly payments and covering it. And if the worst thing that happens is you don't perform, I still own the property, but you've treated it like you wanted. You're much better much more likely to treat it as a good tenant if in your mind you're going to close on this. So there were guys that were doing a lot of that with the idea, it's like, hey, if I have 10 of these and only 5 of them close, I win either way. So I think that's a reason to do the lease option. And from the buy side right now, a lease option might protect you if there are people out there that say the market's going to drop by 20%. I don't really think that's going to be the case. But if you're an advocate of that, or you believe in that, you just moved here or something and you want to get into a house, but you are a little nervous about the market, then a lease option might be a good thing for you, because then you can bail out. I used to try to structure lease options if I was a seller to say we would do it at appraised value and we'd appraise it at some point in the future. As a buyer, I would always want to lock them in on today's prices. And my goal was that I would either improve the property or the market would go up enough that then when I could appraise it, I would get 100% financing essentially. Does that make sense?
Yeah.
Okay.
Thank you.
Did that answer, Josh? What's a horror story? Like, this is real estate. What's the worst thing that could possibly happen? Yeah. No, so, okay, this is an interesting point. There's 2 different ways to do seller financing. I advocate using an all-inclusive trust deed and note so that the buyer goes on title. And it's declared to the world that you're on title. There's also a thing called a land contract. Technically, yes. Almost every loan that's been written in the last 50 years has a due on sale clause. I know of 0 that have ever been called if you're making your payments. No mortgage company is going to say, hey, you've been making all of your payments, we're going to foreclose on it. So there are due on sale clause. So when we do seller financing, there's an acknowledgement by the buyer that says, I understand I'm doing a note, an all-inclusive wrap on an underlying loan that has a due on sale clause. If this note is called, it's my responsibility within 90 days to figure out a way to finance it. And again, it has never happened. There are things we do. I always set it up through an escrow company. Escrow specialist is who I use. And that gives some accountability. So the payment is made from you, if you're the buyer, directly to escrow specialists. They make sure the mortgage payment is paid, the tax and insurance are paid, and any excess money is left to the landlord. If you're involved in the deal, I would recommend that you do that, because if the buyer stops making payments, then you're all of a sudden pulled back into the deal and you're looking to try to keep the records and everything. And that would be a problem if the mortgage payment wasn't being made. So if you are on the seller side, you'd want to either make sure it's set up through a third party or be darn sure you're paying attention to make sure that payment is being made.
So my understanding is that your recommendation is close to that escrow company. I've heard of it too. But pretty much anytime you look at the seller financing deal, that risk is there. They call it, but it's extremely unlikely because
Yes. And what I used to always do, the one thing that would notify the mortgage company that something may have happened is if there's a new insurance policy in my name instead of the seller's name. And so to wipe out that risk, I would just agree that I would pay for have 2 homeowners policies on the property. So that the other thing is that there would be some question, depending on the homeowner's policy, if the house burns down, if both of you are covered, if there's like a gap in the value. And so for $500 or $700 a year, it seemed like when I was out as a proponent to these as a buyer, particularly because I'm a licensed agent, I wouldn't want to put anyone in this sort of risk. And that also was a trick someone taught me. They said, as long as Josh is the owner, still has an insurance policy, he can reduce how much the policy is to a certain extent. Then as a buyer, you would go and either get a landlord policy or a second policy. But again, even before I started doing that, I would go get a whole new insurance policy. It would be named in me, and there's somebody in the insurance company needs to check a box to make sure there's still a policy, an insurance policy on the house. That's one of the requirements of having a mortgage, which you would think would be a flag to say, oh, maybe they sold this on seller finance. And again, through every market I've been in for 28 years and doing this, I've never heard of any loan ever getting called due as long as payments were being made. I mean, that's why mortgage companies are doing loans. They want someone to keep paying them because they're making money on it. And I mean, if they have loans, they have a certain percentage of people aren't paying, and that's where they would put their focus on calling it. So the land purchase contract, or what was it? The land contract is a little bit different. I'm not an advocate of that. There are others that are. There's a title guy in Sandy that teaches that class a lot. And that one is unrecorded deed that the buyer has, and the ownership stays in the seller's name. And he has valid reasons of arguing for that. I just never got comfortable with it. For me, I never wanted to not have title. I wanted to have more control over it.
What they do is they have a signed escrow, signature escrow, and then you have the claim deed. So if the buyer defaults on it, then they record the quick claim deed and it goes back to the seller. But once the payments have all been made, they've already signed the deed, so it gets over to the
Yeah. And so there's some advantages and advocates for that. Again, I never liked it because I feel like if someone put a judgment or someone put another lien in there, if you have an unrecorded interest in a property, there are some risks that come with that. And it was a bigger risk than I wanted to really take on of that, but it is something that people do. Any other questions? And we can go back to kind of where we were. Yeah, go
Sorry,
ahead.
yeah, So you were saying all-inclusive deed versus just no deed of trust. All-inclusive is usually if the seller has a mortgage,
Mhm.
correct? And the deed of trust is based on outright. And at that point, do you really need an escrow specialist? It's probably better.
Yeah, I always would, just because if you think about, if you're making payments for 3 years and you're going to sell it, and it's your records versus their records to say, hey, you missed this payment back in January, or you shorted me this much. I love the escrow company as a third party just to do all that accounting and have the reporting. And again, it depends. If it's $100 to set it up and probably $20 a month, and if it's too skinny to do that on a deal, you probably shouldn't do that deal. But she makes a great point, and that's on the seller financing addendum. So if let's say Josh owns his house free and clear with no mortgage, then it's just a note with a trust deed. So we would record a note of what the terms are, and then the trust deed just records for everybody to know that you have, that Josh is owed the money for that house. The all-inclusive, we also call that a wrap, where you're wrapping the underlying. Most times it's going to be a wrap. I mean, very few homes are free of any debt completely. So.
Do you know any other besides escrow specialists that do perpetual escrow?
No, I think there were more companies that were doing it. Some title companies might do it. At one point, one of the banks here in Utah County was doing it, and I think they got out of the business.
Liability there.
It's not a glamorous type of a thing, and there's not a lot of money in it. It used to be that 50% of the title companies would do it, and I see almost zero title companies doing it now, just because for $20 a month, it's just, they don't want to be involved in sorting through all that stuff, and it's quite a bit overhead. So I just want to highlight a couple of points on the seller financing addendum that we were kind of talking about. One of the maybe. And this is, again, it's an approved form on the MLS, so it's really pretty self-explanatory. But this is where you have the choice that you just talked about, whether it's a note and deed of trust or note and all-inclusive trust deed. It also asks who's going to create the thing. I always put a buyer. If you're the one buyer, whoever's creating this or proposing to do it should create it. And the answer is it's the title company will create it. I can give you guys examples of just a personal note, or you can get those pretty easy. And the trust deed is something title companies do all day, every day.
They're doing an all-inclusive trust deed. My understanding is there's some law that ties them in with cancel. Like 30-year mortgage. A lot of people will put balloons after 5 or 10 years or whatever. But I think, my understanding is all. Not the right mortgage, can't do that. Heard that?
No idea. No, that almost all of them that I do are less than 30 years. It's hard for me to imagine a scenario that any seller would allow 30 years. So the experience that I have, everything has had either a, like we talked about earlier, the 1 year, 3 years, or 5 years, depending on what you're trying to accomplish for your buyer.
Yeah. And what's the guy in Sandy Jackson?
What's that?
The guy in Sandy that teaches it.
He's not my guy. He's a guy that teaches that. He's a big advocate of the contract. I'm not.
Yeah, he's an attorney, he owns a title company.
Uh-huh.
I think he's the one that was talking about this, and I can't remember, this has been 5 years since I. Saying that you can write in a balloon payment. But no one says trust you. So,
Honestly, I've never heard that. And part of the reason I don't subscribe to Jax's stuff is I think he gives misinformation to sell the thing that he's selling, which is the contract. So again, I've been doing this over and over, and I've never heard of an all-inclusive have to be 30 years. It doesn't make any sense to me. I'm not saying it's not a possibility, but it's for the purpose of what we're trying to teach you guys to do. And I mean, Dean's here on compliance. I mean, as long as it's disclosed that there is a due on sale clause and everybody's comfortable with that, most of these have a due on sale within a balloon payment, depending on what if your guy just needs, whoever your buyer is just needs to get their credit right or get seasoning on the job, it could be as short as a year. I usually say give you 3 years because it might take you longer than you thought.
so are you spelling out if you're writing this subject to the existing financing, where you're gonna take over the payments? Spell that out in your seller financing.
So you're not, I think you're maybe even confusing with a loan assumption, because you're not really taking over the payments. On this seller finance, you're saying we're borrowing from the seller 300,000. And we're just proposing, again, what you would propose what's market. Usually, typically a seller, you would think you could offer them either more than market if you're trying to entice them to do it. So like if Dean had a house, or go back to Josh's, if Josh sells his house and puts $200,000 in the bank, he gets 1.5% interest on it. If he sells to me on seller finance, instead of taking the money, he might be able to get 6 or 7%, which is a pretty good return for something to do. So you're spelling out this, and the payment is made to the escrow company and they pay the lender, but it's not an assumption. There is another thing where you can assume a loan. That's probably a different class, and that is a qualified, you work through the lender to get qualified to take over the loan that's existing. And I think that's probably pretty valid in this market coming forward, just because there's a 3% gap in what interest rates were a year ago and today.
I had a situation where I bought a house that rented. Sellers were Arizona attorney, very comfortable with anything, but he would just say, make a payment to the mortgage company. And so I was writing a rent payment to the mortgage company, and finally when we bought it, I just kept making those payments here. And what happens is if you have a history of making payments, it's very difficult for them to come out at any time in the future and go, well, we decided we're gonna do a dual sale. Accepting my money so far, and so there's some court cases on that have kind of failed the lender.
But what was were you a tenant or were you buying it on contract?
I had a tenant, I was a tenant and I bought it on, it wasn't a contract for deed, it was, we transferred the title. So I was not private at that point, but I was paying that.
Okay. I don't know all the scenarios. So that brings up another maybe not in your case, but for a lot of you guys, if you have buyers that don't have enough credit or good enough credit, the other reason to use escrow specialist is if you can show a history of 12 months of making those payments, then you can have that scored into your credit score and increase that. So that's really something to look at. So then we're going back to on the terms, you can offer any of this stuff. And again, depending on how compelling or the scenario, I think the first thing I would do before writing any seller finance is have a conversation with listing agent. Are they open to it? Do they have underlying debt? Can you tell me how much the underlying debt is? Is this a possibility before you, I think if you start writing up offers that are all seller financing without talking to anybody else, it's going to be, again, this is not every seller is going to be open to this. So on this one, I just went to the amortization schedule, $1,800 a month. First payment would start September 1st. So that would be a month after we close it, August 1st. You can put in there if there's a late payment. This is where you specify that it goes directly to a escrow company. They want to know who's paying for the fees on the escrow company. Title insurance, there's two things on seller financing that you may want to think about. One is you don't necessarily have to have title insurance, but most title companies will not close it unless they're issuing a policy. So if there will be a seller's policy, there just wouldn't be a lender's policy. And where the seller is the lender, again, you may have to end up paying for a lender's policy for the seller. It feels like duplication and kind of a overkill. But if you want to have your title company close it, you probably have to pay a title policy.
Quick question. If the buyer stops making payments, how much should we rate? Are you giving?
Yeah, you have to go through the foreclosure process, and all of that is spelled out in the trust deed and note. So that has language similar to a mortgage. It says what happens, how the foreclosure process happens. That is one of the advantages of what he's talking about, the tax on the sales contract. It's much quicker to foreclose and easier because the quick claim deeds are already there. But it would be a typical foreclosure and probably take 90 days notice and then another 90 days to get them out. So that is one disadvantage for the seller.
Non-judicial foreclosures.
Yeah, if they're doing it on the contract, you can spell out in this that it's non-judiciary on the trust deed, and it can be a lot faster than what would be required by Wells Fargo or something like that, but it still is. And I think if you're talking a seller into it, they do have to understand that it is a legal process to foreclose on it. The other thing other than title insurance is there's a spot in here that talks about whether the buyer will have to submit all of their financial information. And certainly I would think that you would want to if you were the seller. I mean, the one reason you wouldn't is if someone's putting $100,000 down on a $200,000 house, you don't care that much. But in most cases, you'd want to have either their financial statement and a credit report pulled to help protect your seller, to make sure they're not a serial dirtbag and really creating a lot of problems for you. Any other questions on this, the form or the seller financing?
One of the problems they had in the past for investors who would go out and was highly leveraged, so there was a ton of equity that they had to come up with. So they get in with almost nothing down, and then they would rent the property out. And
that's exactly what I would do, except for not making the payments. So
they're collecting the rent still from the tenant, the rent type thing, but they're not making the payments. So the seller is getting, holding the bag on that. So what you try to do is set this up so it's a win-win situation on both sides. Both sides are protected.
yeah, does that make sense to you guys? That would be one of the risks, and there always is. If people aren't going to uphold their contracts, that is one of the risks. But I think, again, I come from the world of wanting to own as much real estate as I possibly can. And I've acquired a lot through this. So where he was going was put as little down and control the property. To me as an investor, that's awesome. So if I can work a deal like that and I can acquire, instead of putting 50 or 60,000 down, and I can do it for 10,000 down and do seller financing and make payments. And sort of my strategy was I would go in, clean up the house, manage it better than they were managing it, and get the rents up, get the value of the property up, maybe have to do some work on landscaping, something, and create some value so that, I mean, again, that doesn't happen overnight in most markets, but I would be committed to the property and doing that. And I would have to come out of pocket on the repairs and things. What he's saying is, like anything else, sometimes there are dirt bags and fraudsters that screw up things for everybody. And I think if you're involved in the deal as an agent, you would want to look really hard at that. And again, if you're going to advise a seller, you want to make sure your buyer is legit, has decent credit, and I would look at all their finances. And those of you who have, you guys looked at credit reports, I mean, those of you who own real estate, when you look at it, you can pretty much tell if somebody's had a few problems with their credit or if they're committed to being a total, credit liability their whole life. I mean, it's amazing some of the credit reports I've seen over the years where someone has a 15-year track record of judgments, foreclosures, evictions. I mean, you get a pretty good idea of who people are. And on the investor side, again, I wouldn't spend a lot of time with investors that didn't have much money to put down. So if they're trying to get in a deal for 1,000 or less, that does sound like they may be setting themselves up. And again, I just said that's something I did to acquire properties, and yet I followed through on it. So there are ways you can do it and it makes sense. Not all of them end up in that scenario. Appreciate you bringing up how it could go bad. I think we always want to be aware of that as agents.
Time period, but like with an FHA loan, you're not supposed to sell in, a year. So with seller financing, is it like the same thing? Where you have to hold the property for 6 months, 12 months.
If in order to get financed, or as far as the relationship with the seller?
Well, I guess that's it. Well,
Okay. So again, if you think about, if you're doing seller financing, Josh is the seller, you're the buyer. It's whatever you guys agree to. So it could be, I would put that there's a balloon payment in 3 years to make sure you have time. But I also put on there in the comments in additional terms that there's no prepayment. So sometimes in seller finance, I would say if I wanted Josh to keep paying me 7% for 5 years, I would say there's a prepayment penalty if he pays me off prior to 5 years. But if there's no prepayment, and which what I would put is if you can go, if someone comes along and offers you a great, sells the property because you own it, you can sell it in 3 months, then you ought to be able to do that. Most lenders, if you're going to use it to increase your credit, they do want to see you seasoned on that for, I would think, at least 6 months and most likely 12 months before they'll say, hey, we'll increase your credit and give you a loan based on your payment history on that. Any other questions? You're kind of quiet over here. Okay, great. So I guess I just want you guys to really try to be creative and think about different ways when you can use this, because I do think you're going to see more and more of it, particularly for you acquiring properties. When you guys are calling for sale by owners or expireds, or if you're out doing deals, it doesn't hurt for you as an agent to try to do some of these deals. If your goal is to acquire some real estate, what do you have to lose? If you're spending time looking at the MLS and shopping for properties and you see something, why not call the agent and give it a shot, or just throw an offer out there? You never know. If now that houses are sitting and people's expectation of what they thought they got, one way you can pay a little more for a property is if you say, hey, gosh, if your property is sitting at 400,000 and every other buyer has to pay 6%, maybe just say, hey, I'll give you the 400,000, but I want seller financing and I'll wrap and take 3% interest for the next 2 years. So you could even pay them a little bit more. If you think about how much you're saving, you might even be able to pay them, say, I'll actually give you 20,000 more than your asking price if I can get my payment lower. And if you go through the amortization schedule, if your payment is $500 or $600 a month less, and you carry that for 2 years, you've really made up the difference. So the seller thinks they're getting more money. It's a win for them, but you're paying on that 3% as opposed to someone else getting a 6%. So it's really a competitive way to look at it. And I just, especially when I was new and young in real estate, I just couldn't buy real estate fast enough if I had to save up 10 to 20% each time I bought something. So I was always looking for ways to do it. The other thing is there's all these guys that are investors that have become investors over the last year or 2 years because it's been very trendy to be. I mean, HGTV makes it look very easy. Everyone has friends that own a bunch of real estate, and it's not easy owning real estate. I mean, there's more to it than people think, and there are people that have got into the market who have bought investment properties that just aren't cut out for it. And if they have one bad tenant or an eviction or a meth cleanup or something like that, they may just not have the stomach for it. And those guys are great candidates for you also, because they may be looking to get rid of their property, or they're, you know, a headache that they don't know how to solve.
The other thing is, obviously, if you're buying it from somebody who's lived in the home, it creates a little bit of problem for them because they're not able to get their tax exemption capital gains. I did this. I started out in commercial, so we were doing.
But I think what you just said is inaccurate.
Well, if they're taking back a mortgage, getting paid monthly instead of in a lump sum.
Well, you can set it up so the transaction happens. So if it's my primary residence and I sell to you for 600,000, I have the exemption. So I'm not paying the capital gains on all that. So you lock in the sale, the transaction. You still may pay annual on the mortgage. You're getting mortgage interest, which is regular income you would pay, but it's not that you all of a sudden are paying capital gains also.
But, you know, I found it's easier to talk somebody in if it's a rental property or sometimes it's a probate property where the person is passed, you know, it's on the title, it's passed, but they don't care, you know, about their credit rating and stuff like that. It depends upon what the heirs buying, join the property really want. And the advantage that we would sell it at is that if you are coming in and you're going to pay the 4% interest on this, then they're making 4% on whatever money you put down or didn't put down. And if you have a $200,000 loan on there, you're making 3% interest on the loan. They make the difference of the interest on that loan. So they're making interest off the bank's note because you're paying 4%. That was only 3%.
Yeah, it was the point I was trying to make in the class at the beginning. So
Oh, I'm sorry. I missed that.
no, that's one of the advantages for a seller, is that if there is a gap between the interest rate,
All right, sorry.
that's fine. You guys want to talk about lease options at all? So that's, Dean, are you okay with lease options? Any other questions on the seller financing or the forms?
One thing that I do, just one thing I feel honest, I have in our documents. This option for seller financing, school instructions, so that you know where all the monies are going. It's a protection because way back when I was a brand new builder in 2010, we lost a lawsuit. Lease option purchase. The value of the property gone down. The seller buyer would put $20,000 upgrades in the property, everything else, but it couldn't get the financing at the end of that 5-year period. So we ended up losing the property. And the seller came back and took the conditions because they weren't taking instructions. So we have that. So you guys are doing come talk to me. So I just have a simple instruction to say that if you get a portion now, a portion later.
So related mostly to the brokerage fee.
What is that?
Related mostly to the brokerage fee.
Yeah, to commissions.
Yeah, that's a great form, because if you're doing a lease option or seller finance and there's not enough money and you want to wait, you've got to make sure there's some documentation. Again, I would always require that there's enough cash down so you can get paid and move on, but doesn't mean you have to. I've actually lent my commission as part of the deal and got paid interest on that also. It's probably not for everybody, but that's something you could work out with the brokerage also. Actually, the Sugar House office there was a $25 million transaction up at Powder Mountain, and part of that commission, I think we had to contribute and got like a 12% interest for 12 months as they were finalizing a couple things. So it was a pretty interesting deal. But it was certainly something we wanted to have documented pretty good, because you don't want to be chasing, trying to get your commission 3 years later when this thing either goes good or doesn't go good. Great. Okay. So are you guys going to do this for clients, or you think you can do it for yourself to buy more real estate? God, buy more real estate.
Well, I'm actually under contract right now, so I'm actually working right now, so I apologize, but I kind of was, I had a question on some of the stuff in terms of getting your monthly payment. I moved up on a floor, I think it's accelerated, and I really close. How do you find that?
I just use on the MLS, there's a tool, the mortgage calculator, and I just put in the amount and make sure that it's not putting, if you want to have taxes and insurance included, which is something that'll be specified, and just calculate what the mortgage amount is. So on the one that I showed you guys, I think I had it as $1,800, and it was just that's what it, using the MLS tool, the mortgage calculator, I just put in $300,000, 6% interest, 30 years amortization. When we're doing like hard money loans on fix and flips or investment properties, a lot of times it's just it's not amortized, it's just a straight 12% annualized interest, and you're just making interest payments. But usually on seller financing, it is amortized just like a regular loan. And if you run into trouble, call any loan officer with an HP, can give you payments like that. They love doing it. It's what they do naturally. So the only difference on this lease option, we can run through this pretty quickly, is again, you're just putting some money down. This is an MLS form also. And if you're representing the buyer, you would want to try to lock in the price now and have some time for the value to go up, unless you're of the belief that the value is going to go down. And if you're a seller, you would want to have as much of that money non-refundable and go just towards the option, and less of the rent payment go towards the purchase. And that's just negotiable. But again, where this can be, I think, a tool right now is if somebody is on the other side of I think you were having a call with somebody that's in Virginia that just has it for sale by owner. And how long had they owned that house?
I think less than a year. So she bought it from D.R. Horton. Mostly I was picking her brain because I was trying to poke holes and I was probably 18 months or less.
So depending, she may not have that much equity. She may not, like, especially new construction, if you've had to put in a yard and blinds and all that stuff, you're probably upside down on it. And if she's on the other side of the country, that might be a great candidate either for a seller finance or a lease option. So let's say you have somebody that would love a D.R. Horton home in that neighborhood, but can't quite afford it. You know, you might want to go in and say, hey, we'll lease this thing for $2,500, but we want to have the option to purchase it at the end of the term. So
same purchase price agreed on initially. So I had a situation with that, and I wish I bring that up. So I had a client, I'd like to say, they ended up not buying because of this, but they had moved here from Mexico while they're getting their papers. They did at least their own option. It was with that local agent who wrote it up basically saying like we need $18,000 deposit. The 1 year they had to buy it, so basically that money was forfeit and they were sell the house. They didn't understand it. So my question, I guess, what is my question?
well, that's kind of what he was saying. Like, you still have to be careful because there are savages out there. Like, to me, if that's almost taking advantage of somebody who's trying to become a legal citizen. And I mean, that process could take a lot longer than that. Almost feels like someone was just predatory setting them up to fail.
People didn't understand it. They thought they so they lost $18,000. That's when they contacted me. They said my landlord's kicking me out. We thought we owned the house, and I didn't understand it. I sent my contract. I read through it, and I was like, no, what they really had to agree to is that at the end of the year, you either had to be qualified to buy it, or they terminate the lease and kick you out.
Yeah.
So, yeah, I guess I was just curious because I mean, I've seen it before.
Opposite money is by definition non-refundable.
Yeah, and on the lease option contract, it lets you say whether it goes towards the option. There could be no option money. You could just say, I'm doing a 3-year lease. And to me, for this lady, if she's a out-of-state landlord, and if you want to try to get in there with her, I mean, I would say, let's try to get you a 2 or 3 year lease. And then usually when there's an option, they can close at any point in that 2 or 3 years. But that they have to give notice at a certain time. On the lease option, it says like if it's 3 years is the end of the lease, you have to give me a notice within 6 months before the end that you're going to perform on the option.
That might be my question. So if it's like that situation, so let's say when I said, hey, I'm doing this option, $500 a month to get it per. If that, so that client can't afford it right now, is that the goal there to get them within that 3 years, the ability to purchase it from that seller? Is that what you're saying?
Yeah. And think about it even more, like owning real estate to me is the greatest thing in the free world. Like it's so, and controlling real estate. So even if they don't buy it, let's say whoever you put in there, I happen to believe the market will continue to appreciate, not as much, but I think there's very little chance that that DR Horton house is worth less in 3 years than it is today. So if you could get her to agree to whatever her number is, what was her number? 620. To say, we'll lease it for 3 years, and at any point in that 3 years, I have the option to purchase it for 620. If you're representing a buyer on that, what do they have to lose? I mean, if the market goes down, they just don't perform on it. And then to make it even better, I think you could put in something that, you know, $300 a month or something goes towards the purchase price, so they have more incentive. The other thing that I really like about that, and I would put in a lease option, is that they have the option, they can sell it also. So it's like, if we get to 2 years and it's worth $750 and I'm the tenant and I have that option, theoretically, I can tip up a sign, offer for sale. I'd have to say I have an equitable interest based on my lease option. I don't own the property.
So cash out your equity.
If someone gives them $750, then obviously you're going to exercise the option for $6, whatever the number, and you've made the appreciation over 3 years. Now, that cuts both ways if the market goes down. But I think that lady is the exact prospect that if you're paying attention, there's going to be a lot of that in the next 2 years, because we've been appreciating at 24% a year. So everybody, it doesn't matter what you bought in the last 5 years, you can sell it and still make money and brag to your friends. And I think what we're going to see is a stabilization of the market, where we'll probably see 2 to 4% appreciation, and people will freak out and act like we're losing money or it's crashing. And I think in some areas of our market, we'll also see some dips. I think in the $1 million to $1.5 million, you're probably likely going to see a 10 to 15% drop, just because there'll be so much inventory. And I think that'll be temporary, and I think it'll come back, but it's just, you're going to see the inventory of, it seems like everything that was built in Utah County in the last year is between 800 and $1.5 million. And when you have so many buyers that now can't qualify for that, I think you'll see that inventory stack up and be a short-term thing. So that's our time. I'm happy to stay here and answer any questions. You guys seem like you're ready to go rock, to go do a deal or something. Teach the class later this afternoon with him.
So basically on an option, you're, as the buying property, you record a memorandum of options on the title. So you claim the right to sell it if you need to.
In that scenario, I guess you could, or you could just spell it out on a addendum of your lease. I mean, this is a lease agreement with the option, and there's an area to put additional terms. It's my belief, if I have that option, that I can do that. But I would probably, if that's your plan, you may want to spell it out, or just when it comes close, you just say, I think if I know I'm going to do that, I would say, hey, Josh, I'm going to exercise my option in the next 6 months. I'm going to go sell the property. Just so it's, I mean, you want to be open and notorious about what you're doing. I feel like you have that right with a lease option, and you may want to, just to protect yourself, put it in there. You can record any lease, you can record as an interest in a property. And the only advantage that does is if they really want to watch, make sure the seller's not encumbering it further to a point where they couldn't sell it to you.
You don't use the escrow to deed in.
Not on a lease with an option, because the purchase really isn't happening. I just have the option to do it.
Problem that I see is that if it goes up in value, the seller knows it's going up in value, then they're going to go, I'm going to sell it to you that price more because it's gone up.
But I know if you have a contract that says they're going to, they don't have much to stand on.
Contracts here. And the other thing that I've run into is that lots of times seller, they turn around, they sell the property without you knowing that. And
Lots of times.
well, I mean, it's happened.
Okay, well then I think if you're doing it, then you should put just record the interest, because then the title search would show that you've got that, and you can record any lease on a property.
or just a memorandum?
I
of
think
interest?
it's just dangerous. I'm not trying to pick on you. You're kind of jumping in here, but when you make terms that lots of times sellers, like when a once in a while thing happens, and I mean, you're like trying to scare people into not doing deals. We're trying to talk people into going to do deals.
Well, I'm not scared to do deals, I'm trying to keep it where they're.
I mean, how many times have you been involved in a transaction where someone had a lease option and the seller sold it out from under them?
You just hear about it. so.
Yeah, well, you just said lots of times it happens, and that's all. I just don't want to put in their minds that the deals I'm trying to teach them how to do is gonna end up in court. There's certainly liability on anything, so. Any other questions? Go do some deals. If anyone wants copies of these forms, you're welcome to send me an email. It's boyd@kw.com. You can just keep it as a dummy. I also have a trust deed and note that I'm happy to share with you. Again, let the title company do the trust deed, but you can kind of do a note if you're doing seller financing. And talk to Dean if you have questions, because this does create more liability. Yeah, no, that makes sense. And that is one of the tricks, is making sure the brokerage and the agents get paid. If you guys have questions, if you're out getting started doing them, feel free to call me on it. I really do get a kick out of this. And I think creativity is just, I mean, if you can be creative and put 2 or 3 deals together this year that are non-traditional, that's just more money in your bank and help some clients. So, and I would go after, like, seriously, I think I would possibly go and do some sort of a campaign against every edge home that was sold in the last 6 months and just start dripping on them to be like, hey, do you need to get out or something like that. The other thing is all these edge homes, and I know because a lot of our agents are investors in them, but they have a pretty high number of investors too. So there comes a point, if the market goes down just a little bit on those, people are trapped. It's hard if you're in a big project like the Exchange and someone gets desperate and sells theirs for $399, it's pretty hard for everyone else to keep getting $450. And so that's the downside of these bigger projects. And I think that, again, if you can think about that instead of, oh crap, and talk about how we're all going to die, that means a whole bunch of deals for us. We can go prospect the edge homes, the DR Horton, some of these deals where there's very little equity if they just bought it and they have a low interest rate. And it's just, I mean, 50% of the transactions in Utah County in the last 2 years probably qualify in that scenario. And there will be less liquidity in these events.
I was gonna post on that one, the Horton lady I spoke to, put you on, my fact finder, she had it listed at 620. I got an email from Edge 9 days ago, that same quote went for 540. I was trying to use it as education tool for him, because she said, well, I have some offers. I said, okay, no problem, talk to my client, but when do you get to respond to those offers by? She said, oh, probably a few days. I'm like, yes, she probably doesn't have offers, right? Or it was a teaching tool, but in that case, I was gonna say this, in communities where things sell, and it was basically racing to the bottom, I have 3 deals that I'm involved in currently that's happening, where one's like a St. George vacation home, one's a town home I was building, I just canceled on, then there's a client to sell condo. There's definitely opportunity there, it's a good way to think of it.
Yeah. Edge Homes canceled 74 build jobs in 1 week when the rates went up 3/4 of a point. So now we're not here to cry for Edge Homes. They're still doing fine and they'll do fine, but that's 74 new townhomes. That's more inventory out there. And whenever there's 74 new houses that weren't there when there was a bidding war 2 weeks ago, there's going to be a little bit of shift in the prices. Somebody has to get off that merry-go-round now and is going to take a lower price, which then sets which we just haven't seen. Everything's been, the next one's always been more money for the last 3 years. So, all right, that was fun. Thanks, guys. Glad to have you here.